Hi there, welcome back. Today I'd like to talk about a phenomenon that is in the news and it does make me uncomfortable. It's a phenomenon of negative interest rates that you're seeing in multiple currencies. The Japanese yen, the euro is getting there, the Swedish krona, the Danish krona, the Swiss franc. And I'll tell you up front that I'm not a macroeconomist. I'm not that well versed in monetary economics. What I don't know about central banks could fill several books. But that said, I have to make sense of negative interest rates before I start doing my corporate finance and valuation questions. So this is more for me than for you, and I'd like to talk through what I think is going on in markets. So let's start off by looking at the facts. It is true that we've had stories about some currencies having negative interest rates, but most of these stories relate to central banks changing their rates or setting them below zero. So the first thing I'd like to show you is what central bank rates look like as of today. And if you look at that table, you can see there are two currencies with negative interest rates. One is Switzerland, the other is Sweden, and two currencies with zero interest rates, Japan and the European Central Bank. Denmark is slightly above zero, but you can see a lot of central bank rates are either close to zero or below zero. Now that by itself is neither here nor there because central banks can set rates. Those rates apply to a very small subset of borrowers, really banks borrowing from the central bank. So in the case of the Fed in the US, they set the Fed funds rate, which is not an interest rate that you or I could ever see. It's a rate at which banks borrow at the Fed window. But that's a starting point. Central bank rates have turned negative in some currencies, and that is uncommon, unusual, perhaps even unprecedented. But what's more interesting are market interest rates, because the Fed doesn't set market interest rates, and in some currencies, market interest rates have turned negative, at least on a short-term basis. The German euro bond rate on its short-term bonds and the Japanese short-term bond rate are both negative. But there's also a long-term bond rate, which is the market rate set for long-term bonds, and there you can actually see the contrast between the euro and the Japanese yen. The euro has positive long-term rates, so it's a very small positive number. The Japanese long-term rate is actually negative. Now you might wonder, why make this contrast between central bank set rates, short-term rates, and long-term rates? You can actually explain away central bank rates by saying, hey, you know what, central banks control that process, they can do whatever they want. It's much more difficult to explain market rates and central bank rates turning negative. And it's much more difficult to explain long-term market rates turning negative than short-term rates, because short-term rates have turned negative before. In fact, in October and November of 2008, during the crisis, the T-bill rate went negative, and you could argue that because of crisis, investors will flight toward, or that flight towards safety can make rates negative. So what makes things interesting and perhaps difficult to explain are that long-term rates in some currencies have turned negative. In fact, to lay out the table of what long-term rates look like, I looked at government bond rates. Note that these are not always risk-free rates, because in some of these governments there is default risk, so you'd have to subtract out that default spread to get there. But if you look at these government bond rates, you can already see that the Swiss franc and the Japanese yen are in fact in negative territory. So that's what's setting off this angst among analysts. What do we do now? What do negative interest rates even mean? Now, as I said, I'm not a macroeconomist or an expert in monetary economics, but when in doubt, I always go back to basics. And I go back to my basics and thinking about what it is that drives an interest. Let me call this an intrinsic interest rate. When I lend money to you, there are three things I've got to keep in mind. The first is, by lending money to you, I'm giving up current consumption for future consumption. And you'll have to pay me something for that. So the preference for current consumption is the first component. That becomes what gets called the real interest rate. Second, if I lend money to you and there's inflation in the currency, it would be irrational of me not to cover that inflation. So the second component is expected inflation. Now, if you're a risky borrower, there'd be a third component, which would be a default spread I would charge you because I'm uncertain that you'll pay me back. But let's assume you're a default-free borrower. The government, and the government in this case is, let's say, default-free. The risk-free rate in the long term should then have two components: a real interest rate and expected inflation. And what's going to drive this? The more I prefer current consumption, the higher the real interest rate will become in an economy, and the higher intrinsic rate should be. So in a fundamental world, an intrinsic world, that's what should go into interest rates. But like everything else, interest rates are set by demand and supply. So there's a second way of thinking about interest rates, which is to think about the supply of bonds and the demand of bonds. And the interest rate is coming up as the intersection between those two. So if holding all else constant, the demand for bonds increases, you should expect to see interest rates go, the price of the bond go up and interest rates go down. If the demand decreases, you should expect to see the price drop off and interest rates go up. So you could actually argue that the market process of demand and supply sets interest rates. Now, what connects the two? Well, remember, the people who demand bonds in the bond market presumably are investors who are thinking about real interest rates and inflation. So there is a feedback loop here which connects intrinsic markets to that demand and supply view of interest rates. Now, if markets were fair and efficient, the two numbers should be the same. But like any other market, the bond market can sometimes do strange things. And the interest rate set by demand and supply can deviate from the intrinsic interest rate. For how long, it's not quite clear, but they can deviate. Why can they deviate? First, you can get deviations because investors are being irrational. Irrational in what sense? They expect to have 5% inflation rate, but they lend money out at 3% because they're playing games in the market. They're hoping to sell to somebody else at a different price. It could be because during a crisis, there is this sudden surge of demand or supply coming into bonds. In fact, that's how I view the flight to safety that happens during a crisis that pushes down interest rates and pushes up bond prices. But there's a third factor that I've kind of left unnamed, which is the giant in the room, or the elephant in the room, which is central banks. And I know lots of people view central banks as these incredibly powerful entities that can make the market interest rate whatever it should be. Now, I don't agree with it, but let's look at the mechanisms that central banks have at their control to affect rates. One of the mechanisms, of course, is that bank borrowing rate that I showed you, the rate at which they lend to other banks, the Fed funds rate in the case of central bank. And that's, even though it affects only a very small subset of borrowers, that sends signals to the market about what the central bank thinks about the economy. Let me back up and explain. When the central bank lowers the Fed funds rate, when the Fed lowers the Fed funds rate, it is telling you, if it's a credible central bank, that it sees weakness in the economy and very low inflation. So there are signals that emanate from the central bank when they set rates, which means that those signals travel into the market. So lowering of rates by the central bank to just its banking customers can cause lower rates, at least in the short term, and perhaps even pull down long-term rates. So the effect there is a signaling effect. Central banks can also take a much more direct role in the bond market. And that's in fact what quantitative easing allowed central banks to do. The Fed came into the bond market and it bought bonds. What does this do? It increases the demand for bonds because it adds to the existing bond buyers. Now, how much a central banking market operation can affect rates will depend on how big the central banking action is relative to the total market. Now, remember, the U.S. Treasury market is a huge market. And even if the central bank is buying $80, $90, $100 billion worth of bonds, it is a relatively small slice, but it could affect rates. So central banks have those two mechanisms, and through those two mechanisms, they hope to affect interest rates. Now, why would they want to do that? Well, there's a very simple reason. And we'll come back and talk about it. But let's think about, given these two perspectives, whether we can end up with negative interest rates in an intrinsic world. In other words, if interest rates are set with real interest rates and expected inflation going into them, can interest rates become negative? Well, the answer is yes, with a caveat. If you have very low or no growth in the real economy, in other words, real interest rates have gone towards zero, and there's deflation in a currency, I guess you could have negative interest rates. Now, what's the caveat? Well, when interest rates turn negative, and I'm talking about nominal interest rates, and you're a person with money to save, rather than put in a bank and lose 1% or 2% of that money, which is what a negative interest rate would do, you could keep it as cash, right? So the historic argument against nominal interest rates turning negative is that people will then hold cash. Well, if cash were costless to hold and transact with, that would be absolutely true. Nominal interest rates could not drop below zero. And in Switzerland and Sweden and Denmark and Japan, people should be taking the money out of banks and stuffing it under their mattress, the proverbial stuffed cash under the mattress. But there is a cost to both holding cash and transacting with cash, and that cost is increased relative to what it used to be 20 years ago, 50 years ago. The first is you've got to stuff that cash under a mattress, right? So first, if you have $1 million in cash, or 100 million, or 200 million, can you imagine how big your mattress has to be and how high off the ground it's got to be before you stuff that cash? Let's say you could. After you've stuffed the cash, you know what you have to worry about? That everybody knows you got cash stuffed under your mattress and it's going to try to break into your house. You got to pay for security. So in other words, holding cash is not costless. It's not like putting your money in your back pocket and saying, I can forget about it because if you have enough money, this is going to cost you. Probably not that much, but there is a cost. There's a second issue, which is now we usually need cash to do transactions. We write checks, we use credit cards. We're not used to using cash anymore. In fact, there are lots of transactions where you probably could not use cash. If I bought a house for $1.5 million and I decided to pay with cash, the first thing that would probably happen is somebody would call in the FBI saying, this guy's paying with cash, he must be a drug dealer. The other is, how the heck am I going to lug $1.5 million in cash to pay for a house? So I think we're paying the price for moving increasingly to a cashless economy. Is banks can lower rates below zero, and we're still leaving our money with banks because we need the convenience of being able to write checks and use our credit cards. So if there's a cost to holding cash, interest rates can turn negative, but there is a lower bound. If interest rates become -2, -3, -4%, my guess is that the cost of holding cash is not going to prevent you from keeping the cash. So there is a point at which you're going to see people pulling money out of banks. So now let's think about why central banks even want to drive interest rates. If you think about how interest rates play out in the financial asset market, those interest rates, especially if they're risk-free rates, become the base from which I build my required return on stocks. So when I go out and buy stocks, I start with a risk-free rate and add an equity risk premium to it. So the risk-free rate becomes the base on which I build the equity risk premium. That's my required return on stocks. And in conjunction with the cash flows in stocks, it drives stock prices. In the corporate bond market, I start with the same risk-free rate, I add a default spread for the bonds depending on how much default risk I see, and that becomes my cost of debt, which if I discount coupons back at that cost of debt gives me corporate bond prices. So holding all else constant, I lowered risk-free rates, you can see that both the required returns on stocks and bonds will go down, and when they go down, I'll be willing to pay higher prices for both stocks and bonds. That is the connection between the risk-free rate and financial assets. How about the real economy? The same risk-free rate goes into a composite risk premium that businesses build in. We call this a hurdle rate, a cost to capital. This becomes a rate of return businesses need to make to invest in real assets, land, building, equipment, machinery, R&D, whatever that real investment is. So holding all else constant, when you have a risk-free rate that's lower, you have a lower hurdle rate, right? If you have a lower hurdle rate and your returns and investments have not been affected, you're able to invest more. So real investment increases. And when real investment increases, it has consequences for real growth, which goes up, and potentially for inflation as well. So that's how interest rates feed into the real economy. Now let's get back to what banks hope will happen when they lower rates. They actually, and I call this a hubristic central banker, a central banker who thinks he's the only smart guy in the room, that everybody just does his bidding or her bidding when they lower rates. So in this world, central bankers actually think they set interest rates. They, using whatever little control they have, they're able to set interest rates. So here's how it works. The central banker lowers interest rates. Long-term rates, not just short-term rates, lowers long-term rates. Because you have lower risk-free rates, the cost of equity and the cost of debt both go down. Stock prices and bond prices go up. So you get a stock market and a bond market boom. Because the hurdle rate for companies go down, they get more real investment going. So there's more real growth. And there's a side benefit. When you lower rates as a central bank, you can weaken your currency. You say, that's awful. Not from the perspective of real growth, because a weaker currency means that your exporters in your country now have an advantage when they export. So maybe there'll be more export-driven growth. So in a hubristic banker's world, they think that they can lower that Fed funds rate or banking rate, and through that have all these transmissions that translate in all this great stuff for both financial asset markets and for the real economy. Unfortunately, the real world is not that cooperative. In the real world, here's what happens. The banker doesn't set long-term rates. He set whatever small rate he has under his control or her control. So when Janet Yellen and the Federal Open Market Committee changed the Fed funds rate, nothing's changed in the bond market yet, either at the short-term or the long-term end. Depending on how much credibility the central bank has, there may be a transmission, we talked about this, into the bond market, into short-term rates and long-term rates. So that becomes a maybe. You don't even control market interest rates. Assume that you are able to move interest rates in the direction you want them to go, market rates. So let's say you're able to push down long-term rates. The rest of the story is not under your control either. The very fact that you as a central bank acted, is going to send signals to both the equity and the bond market. What kinds of signals? Probably bad signals about how much growth there is in the economy, what you see in the economy. Investors reassess the price of risk. What does that mean? Equity risk premiums and bond default spreads don't stay fixed, they change. And often they change in the opposite direction. In other words, when risk-free rates go down, risk premiums go up. That risk premium shift could actually be large enough that it offsets the drop in the risk-free rate, and you could end up with lower stock prices and lower bond prices after the central bank cuts rates. You're saying, what about exchange rates? Well, you went out there and cut rates, saying if I cut my interest rates or reduce my interest rates, my currency will get weaker. But what if other central banks are doing exactly what you're doing? In other words, as the Danish central bank lowers rates, what if the ECB also lowers rates? This becomes a race to the bottom. In other words, everybody ends up with lower rates, and exchange rates might not shift. In fact, exchange rates might move perversely after you've cut rates. Your currency could actually get stronger. Now, in terms of the real economy, here's the potential problem. That risk-free rate feeds into your cost of capital, but because you've affected the price of risk, there's no guarantee that your cost of capital is going to be lower, even though you might have lower risk-free rates. And there's an even more potent problem. That expected return from real investments on projects, assets, whatever you're investing in, that doesn't stay constant. So when you see the central bank acting, you as a company reassess those numbers. So you see the central bank lowering rates. You're saying, hey, that must mean the economy is not doing that well. I'm going to lower the returns I think I can make on projects. So the real investment you thought would happen doesn't also happen. So put differently, the central bank goes out there and lowers rates, thinking all this good stuff is going to happen. Nothing happens. In fact, bad stuff starts happening. I read a news story that the Japanese central bankers were surprised at how the market reacted to their lowering rates below zero. What's the surprise? The surprise comes about only because you thought you controlled all the levers when in fact you controlled none of them. In fact, let me give you some evidence on how I think risk premiums have changed as risk-free rates have changed. As many of you know, I compute the implied equity risk premium for the S&P 500 at the start of every month. This is basically an expected return on stocks based on stock prices and cash flow. So I'm going to show you what those numbers have looked like over the last 15 years, and I'm going to show you the risk-free rate nature. Here's what the graph looks like. Take a look at each of the columns here. If you look at the full columns, each of these columns is actually the expected return. If you look since 2008, the expected return on stocks has been surprisingly stable, around 8%. You're saying, so what? The risk-free rate has dropped from about 4% down to less than 2%. In other words, even as the risk-free rate has drifted down, you see that expected returns on stocks haven't gone down. Risk premiums have gone up to compensate. Now, bond default spreads haven't been haven't increased as much as equity risk premiums, but last year you saw bond default spreads also go up. So that's at least evidence that risk premiums don't stay constant as central banks try to play with interest rates. So in terms of dealing with negative interest rates, here's what I tend to do in corporate finance and valuation. And there are three choices you have, and you can decide what you want to do. The first is, if I give you Nestle to value, you might say, look, I don't want to value it in Swiss francs because the interest rate is negative. You have an easy alternative. Value it in British pounds or US dollars, a different currency which has positive rates. That's a bit of a cop-out. You can run, but you cannot hide from this. But that's the first choice. Is switch to a different currency. Just make sure you stay consistent in doing everything in that currency. In other words, if I decide to value Nestle in US dollars, my cash flows have to be in US dollars as well when I do my discount rate in dollars. The second and potentially dangerous game that some analysts have been playing, and this is even before negative rates, is to normalize risk-free rates. What does that mean? Replace today's risk-free rate with what you think is a normal rate. The only problem is normal is in the eyes of the beholder. I tell people, you tell me, what your normal risk-free rate is, I'll tell you how old you are. And what I mean by that is if you tell me a normal T-bond rate is 5.5 to 6%, you're probably too old to be doing finance to begin with, probably in your 70s. If you say it's about 4.5 to 5%, you're probably in your 50s. If you say it's about 4.5%, you're probably in your 40s. If you say it's 2.5 to 3%, you probably started working 5 years ago. So there's no guaranteed normal that we all agree on. So so that's the first problem. The second is a risk-free rate is what you tell me you will invest in if you don't buy the stock or this investment you're looking at. And if you've normalized that risk-free rate and told me a normal T-bond rate is 4%, and I reject a stock because it's overvalued, and I say, where is this 4% investment for me to invest in? You better find me a 4% investment. So normalization is dangerous, but it's a game that you can play if you're willing to normalize everything. So if you decide to use an intrinsic interest rate instead of the actual interest rate, in other words, inflation and real interest rates to get to, then make sure when you do your cash flows that you're using those numbers to get your growth rates and inflation rates. The third, and this is my preferred choice, is even if you give me a negative risk-free rate, I will leave it negative. It's not like my cost of equity is going to be negative in Swiss francs. So when I value Nestle in Swiss francs, I will start with a negative number. Let's say it's minus 0.5%. The risk premium, mature market premium right now is about 6%. And that's pretty much global. That'll give me a cost of equity. Even if I view Nestle as an average risk stock, a cost of equity of 5.5%. You think that's a really low number. You're right, it's a really low number. And here's the other shoe waiting to drop. If I decide to work with that negative risk-free rate, then I've got to bring that same frame of reference into my cash flows. What am I talking about? Remember I said negative risk-free rates are consistent with a low growth, perhaps a zero growth economy with deflation. When I do my cash flows, I've got to bring in that low growth and deflation into my cash flows, which means my growth rates are going to be much lower. And in perpetuity, which is where they matter the most, I'm going to actually set your growth rate to a negative number. I'm in fact going to assume that if you're a mature company and I'm doing a valuation in Swiss francs, your growth rate in perpetuity is minus 0.5% a year forever. You're saying that's so unfair. Well, remember, you get the benefit of the interest rate being low. I have to cap the growth rate to keep you from kind of having an inconsistent set of assumptions about the economy in your valuation. So what's the bottom line? I don't like negative rates. I think they make me, they don't just make me uncomfortable, they just seem unnatural. I've learned to deal with them, but to me they can never be good news. I cannot visualize a healthy economy that's growing with negative interest rates. So the very fact that interest rates are negative is bad news, not good news. Second, when I see central banks embarking on these negative interest rate missions, they look to me like kamikaze, missions where central banks are first acting a little insane because they've been doing this for 6 years, doing what? Lowering rates and lowering rates, saying, hey, this is going to work, this is going to work. It hasn't worked for 6 years. Lowering rates and hoping that it'll push, make the economy grow faster. So why is it going to work now? And to me, the very fact that they keep going back to this lever, even though it's not working, is a sign of impotence, that they have lost all power, which is kind of scary because as an investor, you want at least preserve the illusion that central banks have some power. And to me, this is a sign that they don't. The third is I think there are going to be consequences from negative rates. For 6 years, we've pushed people who need fixed income further and further into the weeds. What I mean by that is if you're in your 70s and you need to invest your money someplace where you need a fixed income each period, we're making it more and more difficult for those people to find investments to take in a negative interest rate world. So what is it going to mean? They're going to be victims of scams of all kinds. I mean, all I need to do is offer somebody a 3% guaranteed return and they're going to come flocking to me. So as a Bernie Madoff, I don't need an 8% return in this market to get a scam going. All I need is a 3% return. I also think that when you see phenomena like yieldcos, where you take a company and you break it out into a big dividend part and the rest, part of the demand for that is coming from the fact that interest rates have become so low that investors have to go wherever they need to go. And they're going to more and more dangerous places seeking that fixed income. And finally, I wrote about Bitcoin a few years ago, and I've thought about it for a while. And Bitcoin has its it has its problems. There's a paranoid fringe that runs the Bitcoin mechanism that means that it might never make that jump into being an established currency. But I think the more central banks in regular currencies keep playing these stupid games, and these are stupid games of lowering rates to zero and below, the greater the opening they offer to a digital currency that actually meets the requirements for a good currency. In other words, has an issuing authority that you trust. At this stage, I trust a really powerful computer over a central bank any day. And I think that that opening is now greater than it's been historically. So let's see whether that changes things. But in summary, I would not lose any sleep over negative interest rates. I don't lose sleep over any financial news to begin with, but especially not over negative rates. They're not a sign of central banking strength. It's not a central banking conspiracy. If anything, it's a signal of how weak central banks have become. I hope you found this session useful. Thank you very much for listening.